Okay, the big investment video you've all been waiting for. Some of you are asking what these videos have to do with what Kara eats in a day. Well, I'm doing this series of videos because this is a health channel, and from the very beginning I've always said the three main categories have always been health, success, and relationships. And if you make bad choices in any of those, you are creating a serious stress in your life and undermining your future. And the biggest killer is stress. And money is one of the biggest causes of stress. Having your bills taken care of is a really nice feeling that improves the quality of your life and probably helps you live longer. If you haven't watched the first three financial videos yet, you should, because they lay the foundation for all of this. Stop looking for get-rich-quick schemes. It's a good way to lose your money quick. Nothing beats effort, patience, and doing something right. Kara made me smile when she showed up one day with this tiny little stick. I said, "What's that?" She said, "This is an orange tree." And she was thrilled. Words cannot describe how my heart filled with love for her, because this image right here says everything. This right here is the perfect example of investing. Most people want a full-grown tree bearing fruit right away. You can buy full-grown trees, but they cost a lot of money. True investing doesn't. Also, look at her body. She didn't get that overnight. That took many, many years of patience and effort and not giving in to weakness. That's the result of a lifetime of investing in her health and making the right choices. There is no difference between health and wealth and relationships of any kind. Okay, so let's get right into it. The goal is to have enough money coming in every month so when you retire, you can pay your bills, no problem. You're go on vacation, live your dreams, pay for your health and all that. We discussed in previous videos how one of the best ways to do that is having a juicy investment portfolio that pays monthly dividends. There are two kinds of stocks, growth stocks and dividend stocks. Growth stocks are when you buy something for like $10,000 and then you sell it for $50,000. But the IRS takes a third of that and the rest will be used pretty quick, and then you don't have any stocks anymore. Dividend stocks are different. You don't sell them. They send you monthly checks because you're profit participating with the company you invested in. But don't invest in individual companies no matter how hot they get right now, because that's way too risky. You can lose a lot of money real fast. It's much safer to invest in index funds or ETFs, which is basically a bucket of the top 100 companies. If some of them do bad, no big deal. You have the other ones to even it out. I'll give you some examples of popular ones later in this video. But first, you need to understand the rules. Do not invest all your money in the stock market. Markets can crash. It doesn't mean you'll lose everything, because markets eventually recover, and usually much higher than they were before. But it takes patience, and most people panic and they sell during a crash, which is the worst thing you can do. In fact, you should be doing the opposite. When the market crashes and the price of stocks goes way down, that's the best time to buy, because what goes down always goes back up. Well, usually it goes back up. And when it does, it goes up a lot. The seeds of fortune are often sown in times of crisis and uncertainty. Always keep that in mind. And don't put all your money into any one thing. Rule number one, always diversify. Have money coming in from as many different streams of income as possible, so if one of those things goes bad, you have some other forms of income to keep you afloat. Always have some kind of emergency money stashed away, preferably in something that pays you interest, like a government-backed short-term treasury bond or something like that. Don't waste your time with bank savings accounts. They're just not worth it. They have bank fees, and then the IRS takes a third of it, and then you just don't get much of a percentage anyway. Anyway, rule number two. Always live below your means. The biggest mistake people make by far is they always live at the very edge of what they can afford. The moment they make some money, they get a bigger house, a bigger car, and they blow it all on clothes and vacations and lifestyle, and then they invest with whatever little they have left over. That's totally backwards. The moment you get money, the first thing you should do is pay your bills and invest as much as possible. Then use whatever's left over for your lifestyle. And it should be as little as possible, because the more you invest now, the more of a payoff you'll have later, and the better your life will be. And most people don't have patience though, and that's the problem. You know what beats the stock market more than anything else for making the most money? It's not the stock market. It's having your own business. Now, not having a job. I'm not talking about having a job. I'm talking about owning a business. Offering people something they need and are willing to pay for, even if it's being a handyman and fixing things. It is offering people something they need that they're willing to pay for. Having your own business beats everything in making money. There are no shortcuts. A lot of people wonder about getting gold and silver. Yeah, that's a good way to store some wealth, but they're not businesses. An ounce of gold today will still be an ounce of gold 20 years from now. The price might go up a little bit, but it's not the same as a business. A successful company can be many times larger and more profitable 20 years from now. The purpose of gold is preservation. The purpose of stocks is growth. And there are different tools for different jobs. All right. So if you want to play it safe, yeah, stash some gold, whatever. But also remember, usually when you sell the gold, you don't really get what it's worth on the market because the buyers have to take their cut. So it's not really the big money maker that people think it is. You'll find out if you do that. Anyway, so speaking of gold, you know who made the most money during the gold rush? It wasn't the miners or the people finding the gold. It was those who were selling the picks and shovels to the miners. There is no guarantee that any miner will strike it rich, but all miners need picks and shovels. And when you invest, you don't invest in the big, shiny, golden companies. You invest in the picks and shovels that those companies need. For example, don't invest in AI companies and data centers, and because that's the big thing. Invest in the high energy needs of those giant data centers and the land that they are leasing. Yes, there are data center REITs, real estate investment trusts, ETFs that include data centers in their landlord portfolios. Don't invest in cars, invest in the toll booths that they have to stop at. That's the mentality that makes you do really good. Picks and shovels. That way you don't have to guess which AI company makes it big. They all need energy. They all need land to sit on. ETFs are great because you don't have to guess what companies to invest in and which ones are the best bets and which ones are doing really good. ETFs already did all that homework for you. So that's why that's really good. Let them do the research and you just benefit from it. Okay, so more rules. You don't get rich overnight with stocks. It takes not years, but decades. And then unless you put a lot in right away, it grows an average of about 10%, which means your investments double every 7 years. You know, $100,000 becomes $200,000 in 7 years. And then $400,000 7 years after that, and then $800,000 7 years after that. And there will be crashes. This is part of the game. People will freak out. You will freak out. Whatever you do, do not sell during a crash. Think of it as an arrow being pulled back. It takes all your strength. Oh, and the arrow is going backwards. That's not the direction an arrow is supposed to go. But then when it just can't go any further, you let go and it shoots forward like a bolt of lightning 100 times further than you pulled back. When the stock market goes way down, do not look at your stocks going, oh no, I've lost half my money. No, the arrow is being pulled back. The stock market has always come back higher than it was before. It might take 1 or 2 years, but you can't stop progress. And usually the lower it goes, the higher it eventually shoots. Like the further you pull back the arrow, the lower the stock market goes. Usually the further and the higher it shoots after that. So always keep that in mind. Never sell during a downtime. This is why you should have a separate savings account to live off so you never touch your investments. The most important thing in making it big in the stock market is not really who you invest in, especially if it's ETFs, because that already covers a whole bunch of stuff. It's having patience. Fidelity did a study where they tracked the activity of the most successful investors, and guess what they found? You know who they were? You know who made the most money? The most successful people who made the most money more than anyone else was people who forgot they had an investment account. I'm not kidding. And the biggest one of all who got the most money was people who died. People who couldn't touch their accounts because they were dead. Those are the ones who made the most money. Most people, they see the market going down, they see things happening, they freak out, they get impatient, they sell. Day traders are the worst. They lose the most money. Just get something and walk away from it. Nothing but nothing beats patience. The difference between successful investors and most people is successful investors invest in stuff and forget about it. Most people check their account every day, every week, every month to see if it's gone up or something miraculous happened. They don't see the money rising very much and they get discouraged. Then when they see it going down to less than it was before, they freak out, they panic, and they sell. Successful investors check their account maybe once a year. One of the best strategies is when money comes in, 20% immediately, automatically goes straight to the investments, no matter what. They have it set up so it just automatically happens. They don't even have to do anything. A lot of people say they only make enough to pay their bills and have nothing left over. Well, if you have a job and you're barely making ends meet, but you are paying your bills, I know you don't want to hear this, but you still have some hours left in the day where you can do a second thing. And since your bills are already paid for, whatever you make with job 2 goes right into investing. So even if it fails, your bills are still paid. You get it? Job 1, the one that you hate, that you're barely making ends meet with, is paying your bills. Job 2 goes right into investing. You gotta just work at it. You gotta work extra. You gotta roll up your sleeves and do whatever it takes. You might have to try 3 different things before something hits and takes off. Having multiple forms of income is so important because there are no sure things. Never put all your eggs in one basket. Do not invest heavily in one thing, no matter how confident you are and how much hype everyone else is creating about it. Smart investors never invest more than 1/10 of their money into something. They invest into 10 different things. So if one of those companies goes bankrupt, or even 2 of them, you still have 80%. That's why ETFs were created. You're not just investing in one company, but a whole bucket of companies. So it's a more stable investment, but be careful. Many ETFs are specialized. For example, a bunch of them are tech heavy because tech is doing good right now. Usually the best stuff to invest in is not the big flashy stuff, but the more boring stuff, like companies that make consumer staples like toilet paper and toothpaste, because people still need toilet paper and toothpaste even during hard times. Again, picks and shovels. Things that people need no matter what the economy is doing. Sure, AI and tech are really big things they're soaring to the stratosphere, but look what happened to BlackBerry and Nokia and Blockbuster and Kodak and Yahoo. They were on top of the world and then they lost it all. Meanwhile, Kimberly-Clark is still making Kleenex after 150 years since 1872, and Georgia Pacific keeps making paper. Warren Buffett, one of the richest men in the world, got that way by quietly investing in boring companies. Monish Pabrai, another famous wealthy investor, says things that move quickly like Bitcoin or GLP-1 Ozempic are the enemy of the investor. That's what everybody hops on because it's doing really big, but true investors avoid the flashy stuff like that. Life has a way of changing overnight from good to bad and bad to good. That's life. The stock market is not for people who are in a hurry. Day trading is for, I say, fools who love to gamble. Haste leads to poverty. Get rich quick attempts are a good way to lose everything. Consistency, patience, and not giving into fear is key. What makes the biggest difference is not buying or selling the stocks that don't do much. It's not selling the few that end up making it big. Now, I know what you're saying. Yeah. Come on, just stop dragging this out. Just tell me what to invest in. Well, that, my friends, in the wealth world is no different than people in the health world that say, I don't care, just tell me what to take. Anyone who thinks like that should not be investing in the market. What you invest is usually not as important as how patient you are. It's the exact same thing in the health world. What gets you into trouble and causes the most disease is the pursuit of instant gratification. People want to feel good right now. They want the sweet stuff, the stimulating stuff. Real health and real wealth is kind of boring. Both require an investment of patience and fortitude. You know what fortitude is? It's the mental and emotional strength that allows someone to face danger, pain, or adversity with courage. That's a good description of patience. Okay, so what do you invest in? All right, I'm not an investment counselor, and I am not telling you what to invest in. Remember, all investments carry risks, so do your own research. I'm just giving you the basics. Like I said, it's very risky to invest in individual companies like Tesla and Coca-Cola and Nvidia and Palantir. It's much safer to invest in ETFs that contain those companies, but they also contain a bunch of other companies, so the risk is spread out. It may sound silly and overly simple, but one of the most basic and popular investments to invest in is the stock market itself. You keep hearing the term S&P 500. S&P 500 are the top 500 companies and ETFs like VOO and SPY, and they track the S&P 500. Now, the stock market can go down, but keep in mind, if a company goes out of business, it won't be in the stock market anymore, and the stock market itself will still continue. As long as there are companies that sell stuff, there will be a stock market. And if companies don't grow, they will not be in the S&P 500, meaning it's pretty much always growing. There are many different flavors of ETFs out there. Spend some time learning what they are. You may have heard of the term NASDAQ. That's the part of the stock market that focuses mainly on tech, high-tech stuff. There are ETFs that follow that, like QQQM, which is a growth fund, and QQQI, which is the dividend fund. There are a bunch of ETFs like VGT or SPDR that hold different tech companies, and there's stuff like the iShares Semiconductor ETF, SOX, that has a heavy concentration in the companies designing and producing the chips that power AI and computing, or AVGO, Broadcom, which is a high-quality compounder for income and dividends. You can make good money with tech and NASDAQ, but you can lose a lot too because it's a lot more volatile than the S&P. That's why a lot of people only have 1/3 of their portfolio in tech and high gain stocks and 1/3 in broad market stocks like the S&P, which are a little safer, and 1/3 in very safe stuff like consumer staples or even bonds or high yield savings or stuff like that. Many people go right for the big, fancy, big rising, flashy tech stocks or like Nvidia or Palantir, which again is very volatile like a roller coaster. But what powers all those computers and data centers? Remember, picks and shovels. EPD is American Natural Gas and Oil Pipeline. That's your toll road cash flow machine, and it's really good for unstable times. Then there's real estate. Don't burn yourself out renting properties and fixing broken air conditioners and plumbing. Invest in REITs, real estate investment trusts like Realty Income, which are ETFs that contain all kinds of real estate and commercial properties so you don't have to. And then there's the safe broad market ETFs like SCHD from Charles Schwab or JEPI from JP Morgan. Have 1/3, 1/3, 1/3 in your portfolio so you're kind of covered. Now, people like to ask about Bitcoin because it's a trendy thing they hear a lot about on social media. Yeah, it could go even bigger than it is, but in short, it's extremely risky, extremely volatile. It's got nothing to back it up, no consumer protection, no regulation. It could cease to exist overnight and you could lose everything. If you're going to play with Bitcoin, I highly suggest you only have a tiny percentage of your portfolio be Bitcoin, only a few percent. Definitely not more than 10%. Consider it no different than gambling in a casino. There are a lot smarter ways to invest. Remember, time is the investor's best ally. Invest and walk away. Don't look at your account more than once or twice a year. Compounding doesn't start getting juicy until about year 10 or 15, and then truly explosive around year 20. Of course, the more money you put into the account, the bigger your results will be. Not faster, bigger. Investing is real easy nowadays. You just set up an account online with a trading company like E-Trade or Schwab or Fidelity or Robinhood or any of these companies down here. You just wire money in and away you go. It's really easy. Remember, you're not going to see much happening the first few years, so stop checking all the time. That can drive you crazy. In the next investing video, I will tell you what stocks I invested in, and I'm not telling you to do the same thing, but I'll tell you why I picked the ones that I did. Investing in your future is one of the best things you can do in any category of your health, your wealth, and your relationships. And always remember, if you lose your wealth, you haven't lost much. You can always make it back. If you lose your health, you've lost something that's a lot more difficult to get back. So get serious with your daily choices, because what you decide to eat and drink and invest in today will determine the kind of life that you will be having not far in the future. And trust me when I say it's worth it.